What if the true source of global power isn't armies, elections, or even natural resources, but an engine so old, so quietly embedded into modern life, that most people never question it? What if the world's largest economies don't just use debt, but depend on it, and subtly guide it in ways that reshape nations without firing a single shot? Tonight, we're pulling back the curtain on a system that looks like simple accounting on the surface. But underneath, it functions as a rulebook for global control. Because the story of debt, the story you were taught in school, is not the real story. There is a deeper mechanism operating behind it. A mechanism governments and central banks rarely discuss publicly. A mechanism that quietly reroutes wealth across borders, decades, and generations. You'll never look at money or power the same way again. Setting the stage background plus teasers to understand this engine, we need to go back long before modern currencies existed. Long before digital banking. Because the roots of the system we use today began as a workaround to temporary solution introduced by early governments when their ambitions exceeded their resources. Throughout history, from European monarchies to early American treasuries, debt was a tool of survival. Kings borrowed to fight wars they couldn't afford. Nations borrowed to build empires they couldn't maintain. And each time the debt came with consequences: loss of land, loss of sovereignty, or loss of power. But then something changed. As industrialization accelerated and economies scaled, governments discovered a new strategy: not to avoid debt, but to engineer it. Not to escape crises, but to manage them. Key figures like Alexander Hamilton, Montague Norman of the Bank of England, and later, U.S. Federal Reserve architects realized something pivotal. Debt wasn't a weakness, and whoever controlled the creation and distribution of debt controlled everything else. But how exactly did they do it? And how does the same system quietly shape the modern world today? Let's move chronologically, because each step didn't just build on the last, it made the next step inevitable. Origins, how the engine was born. The earliest form of government debt looked nothing like today's bonds or treasury markets. It was simple. Rulers borrowed money from wealthy merchants, promised repayment, and if they defaulted, well, the consequences were often violent. But by the 1600s, a game-changing innovation was born: centralized public credit, and later, the United States adopted it. Instead of borrowing from individuals, governments began issuing standardized public debt instruments backed by taxation and state authority. But here's the twist most history books gloss over. Became a product. The more debt the government issued, the more the financial sector grew. The more the financial sector grew, the more influence it gained over government policy. This was the earliest stage of the hidden debt engine, when governments realized they could shape national and international wealth simply by deciding how much debt to create and who received it first. The rise how debt became a global force. Fast forward to the early 20th century.
Owie.
2 world wars reshaped alliances, borders, and economies. The hidden story beneath the surface was the explosion of government debt. Nations borrowed on a scale never seen before. And after both wars ended, they faced the same question. How do you run a global economy when every major participant is drowning in IOUs? The answer was the creation of new institutions, central banking networks with synchronized policies, global bond markets. These systems didn't just manage debt, they redistributed it, refinanced it, and reorganized the flow of capital across continents. And here's where the engine began operating at full power. Debt became the fuel for growth, not productivity. Nations expanded by issuing bonds. Corporations grew by leveraging credit. Consumers lifted economies by borrowing for homes, cars, and education. The economy wasn't just influenced by debt. The breaking point when the engine outgrew its limits by the 1970s, the system hit a structural limit. The link between national currencies and gold was choking the engine. Governments wanted to spend more, but the gold standard imposed a ceiling. When the U.S. abandoned gold convertibility, money stopped being backed by a finite resource, became backed solely by government debt. This was the moment the engine evolved. Now, debt was money. And the more money the world needed, the more debt had to be created. Cause and effect fused into a single loop. The fallout. How the engine shaped modern crises from the 1980s onward. Every major economic event can be traced back to the same mechanism: the Latin American debt crisis. the 2008 global financial meltdown. In each case, governments attempted the same fix: more liquidity, more stimulus, more credit expansion. But each fix made the underlying system more dependent on. Interest rates fell for 40 years to keep the engine running. When rates finally rose in the 2020s, the global system, the one built on perpetual refinancing, started shaking. Governments weren't just managing debt anymore. They were managing the consequences of managing debt. Failed fixes: why every solution makes the engine stronger. When economies grow too fast, consumers borrow. When markets panic, central banks step in with more support funded by future debt creation. Every attempted fix reinforces the same loop. Debt increases the size of the financial sector. The financial sector gains more influence over policy. Policy focuses on keeping debt markets stable above all else. This expands the engine further. It's a cycle without a natural escape. The more governments rely on the debt engine, the more fragile it becomes, yet the harder it becomes to shut down.